This is part 4 in our Receivables and Accounting for Uncollectibles series. And in this part, we're going to be talking about credit card sales and notes receivable. So first, let's look at credit and debit card purchases and sales. And they are treated slightly different. So that's the reason we're doing this example for you here. Restaurants do a large volume of business by credit cards and bank cards. Suppose a Chili's restaurant had these transactions on a Saturday. American Express credit card sales of $10,000 and Visa bank card sales of $8,000. Suppose American Express charges merchants 2% and Visa charges 1.5%. Record these sales transactions for the restaurant. So we'll record the credit card sales first, and remember, our revenues, we record revenues of what we actually earned. So we earned $10,000 in sales. So we're going to credit sales revenue for $10,000. But we're not actually going to receive all of that $10,000, as American Express is going to take out 2% before we get our money. So 2% of $10,000 is $200. So that's going to be an expense to us. So our accounts receivable, we're only actually going to get $9,800 or 98% of our sales. Because again, the credit card discount expense is $200. That's 2% of the $10,000, which is our sales. But we record all of the sales revenue having earned it, the $10,000. So again, we're matching our revenues with the expenses that created those revenues. Now the Visa bank card is slightly different. When a bank card is used, it's considered to be the same thing as cash. So instead of accounts receivable, we're going to use cash in this case. So for this one, you still record the entire sales revenue amount of $8,000. But in this case, Visa charges 1.5%. So this is called a bank card discount expense. And 1.5% of $8,000 is $120. So we're actually only going to record cash receipts of $7,880. Now let's look at notes receivable. For the following notes receivable, compute the amount of interest revenue earned during 2008. Use a 360-day year and round to the nearest dollar. So one thing we have to point out before we do this problem is how to calculate interest. There's a formula. Interest is equal to the principal times the rate times the time. And one thing I want you to be aware of, the interest rate, here we have 10%, 9%, 12%, and 8% for these four notes. Interest rates are always given, unless otherwise specified, in terms of a year. So, for example, note number 1, 10% is the yearly interest rate. That's for a whole year. But notice the interest period is just 3 months. So we have to put the interest period in terms of a year. To do that, we would say 3 months out of 12, because there's 12 months in a year. Now our interest rate and our interest period, or our time, are compatible. And when we do that, $50,000 principal times 10% interest rate times 3 out of 12 months gives us interest revenue of $1,250. What I'd like for you to do here is pause the video and see if you can compute the interest for notes 2, 3, and 4. Okay, so hopefully you've calculated the interest now for 2, 3, and 4, notes 2, 3, and 4. And the first thing you should have done with note 2 is turn 60 days into a yearly period. Well, they said use a 360-day year, and this one's given in days, so we would say 60 days divided by 360 days. that gives us a yearly time period. Times 9% times 10,000 gives us interest revenue for note 2 of $150. Note 3 is also, the time period is also given in days. So again, we divide it by 360 days, times the 12% times the $15,000 principal gives me interest revenue of $375. And the last one is back in months, 6 months. So it would be 6 out of 12 months is the time period, times 8% times the $100,000 principal gives me interest revenue of $4,000. So let's look at some journal entries for notes receivable. Lantana Bank and Trust lent $100,000 to Ben Malam on a 90-day 10% note. Record the following transactions for the bank. Lending the money on May the 6th. So we start with our date, May the 6th, and when we're lending money, that means someone owes it to us. That's called a note receivable, and we're giving them cash. So we credit cash for $100,000. The second thing, we're collecting the principal and the interest at maturity, and it's a 90-day note. So the first thing we have to do is calculate the interest that we would receive, and again, remember the 10% is based on a year, so we need a yearly time. So we'll start with $100,000 our principal, times the rate, 10%, times our time, which is 90 out of 360 days, gives me interest earned of $2,500 over that 90-day period. So to record this, we're actually going to get cash of the $100,000 principal plus our interest of $2,500. So cash received on August the 4th will be $102,500. We earned interest revenue of $2,500, and we're no longer owed that $100,000 in notes receivable, so we have to take those off the books with a credit to notes receivable for $100,000.